In October 2019, a man stood in front of an ATM in the Hamra district of Beirut, trying to withdraw money from his own bank account. His card was accepted, and the withdrawal request was processed. Then, the system froze. This is case number 6. Lebanon's banking shutdown. Inside the branch, the same balance appeared across the bank's internal systems. The value continued to exist within the system, fully recorded, but it could no longer be converted into cash or exit the bank. The man was facing a banking system in which deposits still existed, but withdrawals no longer did. For decades, Lebanon's financial system was organized around continuity. The goal was simple: keep the existing structure operating. The country imported most of what sustained daily life, with fuel arriving from abroad, food crossing borders, and electricity relying on external sources. The economy required foreign currency constantly, with payments flowing to keep daily life going. Lebanese banks adapted to this reality. They received and concentrated external cash entering the country. The cash arrived through transfers from Lebanese living abroad. The funds supported family needs, local payments, and investments. Transfers passed through banks and licensed money transfer services. Remittances supplied US dollars to the country, totaling several billion dollars a year. These inflows allowed banks to meet demand for foreign currency and maintain the fixed exchange rate. Banks offered returns that attracted dollar deposits, making Lebanon a destination for savings sent by Lebanese living abroad and by other international holders. Deposits accumulated inside bank balance sheets, and depositors experienced the system operationally, learning its reliability through repetition. At the center of this structure sat a fixed exchange rate. $1 US equaled 1.507 Lebanese pounds. The number barely moved for years. The peg reduced visible volatility, but it also imposed a strict obligation. Whenever demand for dollars appeared, the central bank had to supply them. As long as inflows exceeded outflows, the system absorbed the strain and the peg held. Commercial banks gathered deposits and allocated them mostly within the financial system. Returns grew with the time money stayed in the system, creating stability on paper. The mechanism relied on continuation. No provision existed for what would happen if continuation slowed. By 2016, the external environment that sustained the system began to tighten. Changes in global economic conditions reduced the flow of dollars to Lebanon. Oil revenues fell, and regional surpluses narrowed. Remittances from Lebanese living overseas also slowed. The shift was gradual and unannounced, with no single event marking the change. What disappeared first was slack, meaning deposits that seemed available were already supporting other obligations. In the same year, the constraint became explicit. Maintaining the peg required fresh dollars. Devaluing the currency would have forced immediate recognition of losses across the system. Instead, the central bank introduced a new incentive structure, later called financial engineering. Banks that brought in foreign currency deposits received returns far above global norms. Yields reached the mid-teens, levels that productive lending inside Lebanon could not generate. The trade worked because the central bank controlled settlement. The central bank could create local currency, but not dollars. Traditional lending slowed. Banks focused on attracting and reusing deposits instead of financing economic activity. High yields attracted deposits. Depositors saw the returns as a sign of strength, not as a warning of the risk it carried. Assets expanded rapidly while liquidity did not. By 2018, most major banks held portfolios dominated by claims. These are rights to receive money from the central bank, usually in the form of foreign currency or government-backed instruments. A claim represents value recorded on the books, but not cash in hand. Depositors still believed their money was accessible, unaware much of it was committed long-term. Banks could not simply give the money back. The central bank depended on the next deposit to meet the previous obligation, creating a chain that relied on constant continuation. The system's critical question: who would be last to get paid? In October 2019, protests erupted across Lebanon. The immediate trigger was attacks on WhatsApp calls. Protests quickly spread across the country, reflecting deeper frustrations built up over years. Banks closed temporarily, framing the move as a precautionary pause. Even before any formal rules changed, This interruption altered expectations. People went to their branches expecting normal access, only to find that withdrawals were slower and transfers required explanations or approval. There were no official rules about that situation. Instead, limits appeared gradually, based on how banks handled cash and transfers in real time. Access varied from client to client, with some able to withdraw limited amounts and others unable to move money at all. Foreign currency left the system through narrow channels. The balances recorded on screens remained the same, but none of this money was usable. Clients started to understand that possession no longer guarantees access. Money existed only as a claim. A new vocabulary entered daily life. Terms like lollers, internal units, and special rates became commonplace. These were ways the banks tracked and controlled dollars that could not leave the system. Lollers were virtual dollars inside accounts. Internal units recorded value that could not be withdrawn, and special rates determined how balances could be converted. Converting dollar balances required accepting rates far from external market value, and most people had to accept whatever was offered, even at a loss. Savings lost meaning. As restrictions hardened, behavior adapted. People increasingly relied on cash. Checks stopped circulating, and cards no longer worked reliably as money. Queues formed outside ATMs for hours, with some clients receiving only a fraction of the expected amount. Businesses struggled to pay suppliers or staff, even when their accounts showed large balances. By 2020, the banking infrastructure still appeared operational. The system seemed intact, but the mechanisms to turn those numbers into usable money were breaking down. Life inside the financial system had become a mix of improvisation and negotiation. Transfers could take days or weeks, and access often depended more on connections and timing than on the actual balance in the account. The major consequence was the way people thought about money. Trust in the banking system vanished. Daily routines shifted, and families kept cash at home. Businesses sometimes delayed wages or payments because they had no cash on hand. The routine of using money as a medium of exchange became unpredictable. Numbers on a screen no longer told the full story. They were claims without guarantees representing potential that could not be realized. An account balance is not money itself. It is a claim on the system's ability to turn recorded value into real money. When a banking system becomes the primary financier of a state that cannot generate external currency, continuity depends on attracting the next deposit. In Lebanon, numbers stayed where they were, but money stopped becoming money. This was the cash files. Case is now closed.